Good morning, everyone, and welcome to today's webinar. I am Chris McCauley, and I'm joined today by Jason Cogdill. We are the two benefits attorneys at ProBenefits. Just a quick note about July. We will not have a webinar in July. July is a busy time for a number of reasons: compliance deadlines, kids out of school, vacation. So we typically skip July, and so we will be back again in August with our next webinar. Today's presentation is 10 Common Benefits Compliance Mistakes. Here's a quick outline of the session. We're just going to give a brief update on some compliance and training tools, a reminder of a couple of compliance deadlines for July 31st, then get into our substantive discussion of 10 common benefits mistakes, and then take your questions via the control box on the right side of the screen, and we're going to try to get to as many live questions today as we can. I think we can answer the most frequently asked question first, and that is that today's webinar and all of our webinars will be available on our website after today's presentation. Anytime you register for a webinar, whether you attend or not, you will receive an email with the recording and the slides. So if you can't make a future presentation, simply register and you'll get an email with the presentation, or check back on our website after the live presentation where you can find our monthly webinars. In addition to our monthly webinars, if you're on this webinar, you're likely subscribed to our compliance updates, which we typically send monthly. And so those compliance updates, as you've seen, generally have a couple of bullet points, compliance topics that are relevant and timely. We also have a new blog on our website. The blog is not necessarily new. The title is Elevation, and we are committed to providing quality, timely content on our blog for employers, advisors, and participants as well. So if you have not seen that, feel free to check it out. In addition, if you ever need a reference, one-pager on any summary on any compliance topic, we have a number of those documents that we keep in our archives, and we share with our clients to help them. If a one-pager on any particular topic may help you, just let us know. Just a couple of examples of one-pagers that we have. We have our 2017 compliance checklist, which you may be familiar with or have received. We have one-pagers on discrimination testing, dependent eligibility for tax-free benefits, tax consequences for same-sex spouses and domestic partners. So that's just a very short list of one-pagers that we have available if that would be helpful to you on any number of compliance topics. Obviously, if you're working with us, you have access to our team for questions and assistance. And also there are options for customized training and education options, whether that be for your team or your clients. If a seminar or a presentation or a webinar would be helpful to you, simply ask us. A couple of quick reminders before we get to Jason regarding July 31st deadlines. First is Form 5500s for calendar year plans are due at the end of July. That's a big deadline here at ProBenefits because most plans, obviously, or a large majority of plans are calendar year plans due at the end of July. The deadline for 5500s is 7 months after the plan year ends, so it is a rolling deadline depending on when the plan year ends, but again, the big deadline for calendar year plans is July 31st. And the summary annual report deadline, which is a summary of the 5500, is due within 9 months at the end of the plan year. So once you file your Form 5500, you then provide a summary annual report to your participants. Second deadline is for PCOR fees for self-funded health plans and HRAs. For our HRA plans, we have assisted by providing our HRA clients with IRS Form 720, which is the form that the fee gets reported on. We've provided that form. Our HRA clients simply need to review the form that we've sent, make sure our participant count is accurate, let us know if it's not, and then go ahead and send in payments. So the deadline this year is for any self-funded health plan or HRA that ended in 2016. So even though we're paying the fee in 2017, we're paying the fee for a plan year that ended in 2016. We have one pager again on both of these topics, Form 5500 and PCOR, so if you need any more details on either of these items, just let us know and we can provide that one pager. And so with that, Jason, I'm going to go ahead and turn it over to you.
Thanks, Chris, and good morning, everyone. This session is a new session that we have not done before, and candidly, this session is the product of indirect request and demand from employers and advisors. A lot of times when Chris and I train on compliance, we try to focus on the positive, for lack of a better way to say it. We try to focus on what the rules are and practically what employers need to do to stay in compliance. And we are not big believers in scare tactics, and what goes along with that is we're typically not trying to come at things from a negative perspective. However, we get asked a lot about mistakes and errors. You know, what are the most common things found in an audit? What are the most common errors and mistakes? So as part of that, some time ago, maybe going back to last year, we started some informal work, some informal polling, some minor formal polling and surveys and discussions with employers primarily, and then also with some partner plan advisors on what are the most common employee benefits compliance mistakes. I originally titled this session the top 10, maybe too much David Letterman from days gone by had that stuck in my mind. I originally titled this the top 10 employee benefits compliance mistakes. After further consideration, I thought we might not be qualified to know what nationally among employers of all sizes, among a wide range of benefits, what are the actual top 10. So let's just focus on 10 common mistakes. So we have a list from our work and our preparation. We have a list of common mistakes that totals somewhere in the range of 20 to 25. What we've done is distill that list to what we understand to be 10 of the most common mistakes relating to key issues. For example, if there's a common mistake that employers make that really has no consequence, we didn't include that on the list. We wanted to include things that have consequence and relevance for your organization and other organizations of various sizes. This is designed to be presented in an interactive, practical workshop manner for employers. So we've kind of converted that method to share it in the webinar format today. And specifically, as listed in the bottom bullet point on the current slide, you know, this is not a test, and this is not measured for you as an employer to know whether you're 10 out of 10 or 8 out of 10 or 6 out of 10. My guess is you're doing a lot of things right in your benefits program. But if there are mistakes that other employers are making or that you may be making, whether you recognize that as a mistake or not, let's identify it. You can make a plan to address that issue and get it corrected going forward. So I hope this will provide some affirmation and confirmation for you, as well as hopefully learn one or two things as well. These mistakes are in no particular order. We're going to start kind of with basic, big picture items and go toward more specific scenarios. But these are, just to be clear, these are not listed in order of frequency of error or consequence of mistake. These are just listed in a manner to allow for ease of presentation. What I'm going to do is just share the mistake, and some of these I'll go into more detail, some of these I won't in the interest of time. And as Chris mentioned, we do a lot of webinars, we do a lot of training, we've got a lot of information. If something here triggers with you a need that you need to learn more on one of these specific topics, let us know. We can either talk to you about it and practically help you decide what to do. We can give you some training information. Most likely there's a topic that we've done some training on before, that information may be helpful to you. So I'm going to go through the mistakes 1 through 10, try not to belabor the point on any of them, and I'll ask Chris to jump in to answer questions and maybe add some of his insight as well from his daily experience working with employers on a wide range of compliance issues. So mistake number 1, and this relates to ERISA, this is a big picture item. Employer does not have an updated summary plan description for one or more of its group-sponsored health or welfare plans subject to ERISA. The reason I listed this number 1 is, frankly, because in every audit that I've seen, which is not 100, but it's a number of them, question number 1 on the audit for a health plan, for example, for a particular year is, please provide, this is a letter, keep in mind, written from the Department of Labor, the Employee Benefits Security Administration, to the employer. Question 1, please provide the plan document and summary plan description for the plan applicable for this particular year. The summary plan description, which is an ERISA document, is the most important piece of paper, whether that's hard copy or electronic, applicable to any benefit plan. Because the plan that we as employers provide to our employees is only as good as what it says in writing. And whatever it says in writing, we as the employer plan sponsor must follow as it relates to eligibility, which I'll get to in a moment, and claims and covered expenses, appeals, everything related to the plan. ERISA, no surprise to you, requires that every plan that's subject to ERISA be described in a written plan document and summary plan description. The summary plan description is the document that should be written in a way to be understood by plan participants, and it should be technically formally distributed to anyone who's an active participant in the plan. And that means either hard copy distribution by the employer, either on an annual basis or every time the plan document changes, or electronically distributed if the employer follows the DOL rules and safe harbor regarding electronic distribution. Now, what do most employers do? Most employers simply rely on the insurance booklet. Let's say the health insurance plan. Let's say I'm an employer, I've got a fully insured health insurance plan and policy with a carrier. I take the insurance booklet, the participant booklet from the carrier, and I make sure it's available to participants, either in hard copy, which is getting antiquated at this point, or electronically, which is more common, and I rely on that as the summary plan description. That is the traditional method. Now, technically speaking, that insurance booklet may not fulfill all the terms of ERISA, which requires that 33 items be listed in a compliant SPD. So those of you who've heard of WRAP SPD, what a WRAP SPD is a legal document that incorporates the insurance booklet but fills the gaps of whatever the insurance booklet doesn't provide, so that the insurance booklet plus the WRAP SPD document together form a compliant summary plan description. Now, in the interest of time, I'm not going to say any more about WRAP SPDs, but that's something we work often with employers about. And what we see commonly is that employers are not aware of the SPD requirement, or they're not distributing SPDs, and so refreshers are often needed for plans. And again, this applies to all employer-sponsored plans that are subject to ERISA. So that's not only health plan and dental and vision, but disability and life and other benefits that are subject to ERISA. So issue number 1, mistake number 1, an employer does not have an up-to-date compliant SPD for all benefit plans. Number 2, a related issue that I referenced a moment ago, eligibility. Common mistake of employers is either not documenting, which it should be documented in the plan SPD, or not following the terms, if it is documented, for basic eligibility for benefit plans. Here's a common example, and this is a question that comes up at least weekly with Chris and with me. Question comes from the employer or from a plan advisor on behalf of an employer. We've got employee in this particular situation, and add facts or details. You can imagine what they are. is this person eligible or not? Now, most of the time that question comes with motivation from the employer or the advisor regarding the ACA. And the question is, typically of an employer, let's say that's 50 or more employees is subject to player pay, the ACA. We've got this employee, are they eligible? Well, the answer is always the same, and the answer is twofold. Number one, the answer is, what does the plan say? Because question number one is not what the Affordable Care Act says that the employer has to do. Question number one is, what does the plan say? Because if the plan says, the written terms of the plan say that this individual is eligible, then he or she is eligible. And the ACA eligibility issue is secondary. A common eligibility provision in a group health plan, for example, says that individuals who are eligible are active, full-time employees with a regular weekly schedule of 30 or more hours. That's just a basic default provision. Employers do not have to follow that provision, but most employers use it. That's the definition in most insurance booklets provided by the carrier, because as you know, in most states, the insurance carriers follow a 30-hour default provision for eligibility. So if an individual qualifies under that definition, then they're eligible regardless of what the ACA says, and regardless of what the employer may intend, the employer must follow the terms of its own plan. For small employers, for example, that are not subject to ACA player pay, then the 30-hour rule doesn't even apply to those employers. And the measurement period and all those considerations that applicable large employers have under the ACA don't even apply to the small employer. So the key for the small employer is, what does the plan say? Is that person eligible? And then there's state law considerations as well. Some states, for instance, our state, North Carolina, has small group rules that also define 30 hours as the eligibility provision. So that's a secondary consideration, but the primary consideration is, what does the plan say? For large employers that are applicable large employers, the considerations are twofold. Number one, what does the plan say? Number two, what does the ACA require if the employer wants to avoid any potential penalties? But keep in mind that if any plan sponsored by the employer were scrutinized at a higher level by the IRS, by the Department of Labor, the key is, what does the plan say in writing? That's always the number one key. So we as employers have to always keep in mind that we have to have the plan written and described in writing, and we have to follow the terms of the plan. The number one obligation of the plan sponsor and the individual plan administrator is always follow the terms of the written plan. And basic eligibility, which seems like it's something that we should all know and handle correctly, based on our experience, is a common mistake of employers. Issue number three, mistake number three, HSA eligibility. And I'm going to pull Chris in a moment because he is an expert on this topic and deals with this on a daily basis, because not only do a number of our employer clients that we assist with Section 125 plans and FSAs and also HRAs also have health savings account options for their employees, but we also deal a lot with HSAs directly and have an HSA product that we work with. And so what we see from all angles is confusion and misunderstanding or misapplication of HSA eligibility rules. Chris recently did a short mini webinar on HSA eligibility and how other coverages affect HSA eligibility, and that is available to you if it will be helpful, because it's a great training tool. But the mistake is this: employer has one or more health plans, at least one of which is a qualifying high deductible health plan that allows employees who enrolled in that plan the option to have an HSA bank account. But the employer does not understand or does not properly handle the HSA eligibility due to other coverages, whether health FSA enrollment or HRA availability or other potentially disqualifying coverages. So net result, the eligibility of employees for HSA bank accounts and tax-free HSA contributions is jeopardized because of what other coverage is available to them or what other coverage they are actively enrolled in. Now, as a short, very quick refresher, keep in mind that for an individual to be eligible for the HSA bank account, and these are not new rules, they've been around for a decade and a half now, since the HSA tool was established in 2004. For the individual to be eligible, the individual has to be enrolled in a qualifying high deductible health plan with minimum deductibles, maximum out-of-pockets, and no copays or first dollar health coverage underneath the minimum deductible. So that's step one. And step two is that the individual employee cannot have any disqualifying coverage. So if the individual has any disqualifying coverage that would pay or reimburse health treatment items underneath the minimum deductible, then he or she would be disqualified. And that could come in the form of FSA enrollment, either of the individual or a spouse, or HRA coverage that pays underneath the minimum deductible, or any other health coverage, even basic indemnity type coverage that paid underneath the HSA minimum deductible. So are these complicated rules? Yes. Are they frustrating rules? Yes. But the key is that if these employees and other individuals are going to be eligible for HSA contributions to the bank account and then tax-free growth and reimbursement, then that the eligibility rules must be followed to protect those tax issues. Chris, anything to add to that regarding HSA eligibility and the impact of other coverage?
Yeah, I think a couple of points. One, you talked about potentially that generally FSA, HRA coverage would disqualify an individual, but those plans can be designed to be offered in a way that are compatible with HSAs, whether that be a limited dental vision FSA or a post-deductible HRA. And we talk about those in more detail in our short mini webinar session. Also, you mentioned this as well, but potentially an FSA of a spouse could disqualify an individual from HSA contribution. Now, that's not something the employer may know about, so there's not much compliance responsibility on the employer in that situation, but it would be helpful, and we do recommend that the employer educate employees about what HSA eligibility is so they're aware and they can protect themselves and maintain their HSA eligibility. And then one final note, I think the biggest, by far the time that this comes up the most is when an employer is adding an HSA, and even more so when an employer is adding an HSA mid-year and they're already offering an FSA or HRA. So if that's something you're planning on doing or considering doing, there are a number of considerations. It's not necessarily a good idea to be trying to add an HSA mid-year if you have an FSA or HRA. So that's another very common situation that comes up where we need to discuss the potential ramifications.
Thanks, Chris. Moving forward, IRS rules, and this one is something we deal with often and probably sound like a broken record on, but it's for a good reason, and this is a recurring issue, and that is that as kind of a second point, I mentioned an SPD earlier for ERISA plans in general, the ERISA compliant SPD. Similarly, plans that follow IRS rules, such as the Section 125 pre-tax plan, must have a written document. So this issue, issue number 4, employer does not have an up-to-date compliant IRS Section 125 SPD. And this is needed to document eligible pre-tax deductions. You all are hopefully familiar that in general, a deduction from the employee's pay would be taxable. Tax deduction, tax withholding would be taken from any deduction from the employee's pay unless a specific tax exemption applies. Section 125 of the IRS code says that if an employer has a qualifying written Section 125 plan, then certain deductions can be taken without tax withholdings, and those include pre-tax deductions for health insurance, dental insurance, vision insurance, flexible spending accounts, health savings accounts, other supplemental benefits, group term life insurance up to $50K, and other examples. I won't go through them all. But in order for those deductions to be pre-tax, the employer has to have a written plan. Same SPD rules apply. Certain provisions must be met. The SPD must be made available to participants so they know what their rights are, what can be pre-taxed, what is the eligibility requirement to be able to pre-tax. Also, what qualifying events apply. When may participants make mid-year changes, if any, are allowed by the plan? The mistake is this: the employer either has an old Section 125 document from way back when that they can't locate, so they know they have one, but they can't locate it, or they have one, they can locate it, it's old, it hasn't been updated. Maybe they implemented a new benefit 3 plan years ago, but it's not included in the SPD. Maybe it's pre-taxing different benefits than are listed in the SPD, or maybe it's even pre-taxing, according to the document, certain benefits are listed that the employer's not pre-taxing, such as LTD or STD premiums, which are most appropriately taken on a post-tax deduction in order to protect the tax-free nature of any future benefits. So it's important that the employer have a written document for the Section 125 plan, that it be made available to participants just like the ERISA SPD, and that it be updated. For instance, what is a qualifying event has changed some in the ACA era. There are new qualifying events and HIPAA special enrollment rights that didn't exist 10 years ago. Also, it never hurts for an employer to do an updated tax analysis of what should be pre-tax, what should be post-tax. You know, are we handling benefits correctly from a tax perspective? But the bottom line is that tax savings through pre-tax deductions are huge. Employees save federal, state, and FICA roughly 30 to 35% on all deductions, and the employer saves the FICA match, 7.65% on every dollar pre-taxed by employees. So those tax savings are significant, and the only string attached to the tax savings is having the 125 plan and following the rules. That's a very small cost for a very large benefit. So this is something simple and not difficult that an employer can do to make sure it's following all those rules. So that's issue number 4 relating to IRS rules. Issue number 5, the ACA, and this is the only ACA item I'm going to mention today. There are other ACA common issues and mistakes by employers, but because we're in this period of limbo in 2017 where the ACA does still apply to health insurance plans and employers and carriers, we are certainly in a period where the ACA appears that it will be replaced, if not soon, certainly, you know, over the longer term period. And there is admittedly loose enforcement of the ACA right now during this limbo period. So because of the current status of the ACA, even though it is the law of the land, what I'm going to do is only mention this item as a single ACA issue, save others for another discussion. Chris mentioned earlier the 2017 benefits compliance checklist, which includes all of the relevant ACA items for this year, of which there are no new items. Everything's already gone into effect. So if you would like to see that, we'll be happy to provide that to you. But issue number 5, mistake number 5, is this: the employer does not know its status as either an applicable large employer that's subject to player pay and IRS reporting, or a non-applicable large employer that's exempt from player pay and IRS reporting. This is key because whether the employer is an ALE or not an ALE, the employer needs to know it, and in the case of a non-ALE, the employer needs to be able to document it in case this is ever scrutinized by the IRS or governmental authorities regarding ACA compliance. This has been a common issue. It's not new. This really goes all the way back to 2015 when the employer mandate first took effect for employers. What employers still, in some cases, fail to know or understand is that whether an individual entity is an applicable large employer subject to player pay, subject to reporting, does not depend on whether or not that employer has 50 employees today or yesterday or tomorrow. The measure is this: whether in the prior calendar year, so if we're determining status for 2017, the key is, did the employer in the calendar year 2016, the 12 calendar months of 2016, have a monthly average of 50 or more full-time employees plus full-time equivalents. Full-time equivalents meaning that for example, two 15-hour employees would equal one 30-hour full-time equivalent employee. Did the employer, or if there are multiple entities, EINs under common ownership, did the group of employers under common ownership average 50 or more FTE plus FTEs for the whole calendar year? If so, then that entity or multiple entities are applicable large employers for 2017 that must comply with player pay number 1 and IRS reporting number 2. If that entity or group of entities had fewer than 50 FT plus FTs, then those entities are not subject to player pay and reporting in 2017. There would be a reporting obligation if the small employer non-ALE had a self-funded health plan, but otherwise there would be no reporting or player pay obligation. But even though this is the third year, as we've gone from 2015 to 2016 now to 2017, frequently employers do not know whether or not they're ALEs. They may think they're non-ALEs, but they haven't documented it and confirmed it, and they may not have done the common ownership analysis or test to see where they stand. So this is a common issue. Now, follow-up question from an employer. How closely is the IRS enforcing player pay and reporting right now? Well, candidly, they haven't closely and significantly enforced it to date, although they have taken some steps. Most of the reporting follow-up from the IRS to date has focused on employee names and social security numbers, but the IRS has put some employers, not many and not necessarily many in our markets, on notice of potential reporting issues, and we started to see some movement toward player pay compliance in recent months, going back the last 2 years, for which 2015 and 2016 reporting has been submitted on behalf of employers. So as of today, again, the ACA is the law of the land. Employers should still follow the rules, even though admittedly we're in this limbo period, and we may be for some time until Congress passes a new law or we have more clarity about what the federal agencies will do in enforcement. But that's issue number 5, and the only ACA issue that I'll discuss today, as we'll move on to other matters. Chris, before we do, any questions or any additional thoughts from you?
We had a quick question about the HSA eligibility. I'll just read the question. It says, "It is my understanding that it is not the employer's responsibility, but instead the employee's responsibility to determine HSA eligibility. We provide the employees with the eligibility rules, but may not know what other coverage they have. Is that correct?" The employer has 2 responsibilities as it relates to HSA eligibility of their employees. First, the employer must ensure that the employee has a high deductible health plan. And then second, the employer must ensure that the employee has no disqualifying coverage through that employer. So those are the only 2 requirements or conditions that the employer must verify. Again, so if the employee has disqualifying coverage through another employer or an individual plan, that's generally not something the employer needs to be concerned about.
Thanks, Chris. Moving forward, and I'll cover these last 5 a little more efficiently. This relates to COBRA. Some of you may have read or be aware that there is some litigation going on in other jurisdictions around the country related to COBRA compliance. And specifically, one of the hot topic issues of the day is whether or not the employer provides, as required by law, COBRA initial notices, the COBRA general notice when an individual first becomes enrolled in a COBRA eligible group health plan, or the election notice when the individual loses coverage due to a triggering event. The requirement by federal law that the individual be provided that COBRA election notice and opportunity to continue coverage, whether for group health insurance, major medical, or for dental or vision or any other COBRA eligible group plan. So with that as context, the common mistake when it comes to COBRA is that the employer does not formally offer COBRA for all applicable group plans. One common scenario is that the employer complies with COBRA for the group health plan or medical insurance benefit, but not necessarily, maybe the dental plan as well, but not necessarily other required coverages, such as listed on the slide, some other examples. Vision coverage, if it's group vision coverage, even if it's voluntary, 100% employee paid, that's still a COBRA benefit. Telemedicine is a unique standalone COBRA benefit unless it's integrated with the major medical plan. Same for health reimbursement arrangements. On-site clinics and other employee assistance options that provide significant medical treatment are group health plans subject to ERISA and COBRA. And some, but not all, supplemental or worksite health benefit programs are subject to COBRA depending on the nature of the benefit and whether it's a simple indemnity plan, which is not generally subject to COBRA, or it's more of a substantial gap plan or other plan that includes payment or reimbursement for specific medical services that would be subject to COBRA. The employer not following COBRA rules is a mistake in large part because of what the market has dictated. As an example, it was common for a long time, but is less common now, that when the employer purchased a major medical insurance plan from a major carrier, that the carrier may provide a free or significantly discounted COBRA administrative option for the health plan. So the employer would take it. You know, free is generally good, right? But sometimes we get what we pay for, and that means, for example, that free COBRA administration for the health plan may leave out in the cold dental and vision and other benefits that needed to be subject to the same treatment for COBRA continuation. The other thing is that the COBRA rules are very strict, and they include a list of required notices. I think the list of required notices includes 7 categories, and then there's some optional notices that are not technically required but suggested for quality communication with COBRA qualified beneficiaries and quality administration of COBRA. The COBRA statutes lay out all these notices. So quality COBRA administration by the employer or by a third-party administrator on behalf of the employer is that the required notices are all sent and they're confirmed, and the mailing is documented in case there's any later contest about whether or not something was sent. So that the notices are sent, and then that there's quality communication. So if, for example, coverage is offered but not elected or paid, that the individual qualified beneficiary is given notice of that, so that there's communication and the COBRA rules are followed, and there's no confusion about what the individual was offered or where the coverage stands. But this continues to be an issue among employers and plan sponsors, so I wanted to mention this as kind of the key COBRA issue.
Quick question, Jason, if you don't mind. There was a question as to whether life, disability, and AD&D insurance are COBRA eligible. And the answer is no, those generally don't fall under the definition of group health plans. So those specific benefits are generally not COBRA benefits.
Yes, very good question. And a question came up last week, a specific question about whether or not the employer could offer COBRA continuation for a benefit or for an individual that's not technically COBRA eligible. The answer to that is yes. COBRA provides the minimum requirements for employers. So if someone's not technically COBRA eligible, or a benefit's not technically COBRA eligible, but the employer wants to offer a continuation option for some period of time or part of a severance offer, the employer has the option to do that if it gets approval and clearance from the carrier, of course, because you want to offer coverage that the carrier won't stand behind. But COBRA is a minimum requirement, and so what the employer wants to focus on is ensuring that COBRA is offered to every individual that is eligible. Mistake number 7, issue number 7, relates to HIPAA. And this is an error that is very common, and HIPAA obligations of employers have changed over the years, so certainly cannot place any blame on an employer that is not currently aware of its HIPAA obligations, but I want to mention this because this is something we all need to be aware of and we all need to work toward in terms of HIPAA compliance going forward. The issue or the mistake is this: employer does not realize its HIPAA obligation regarding the privacy and security of protected health information, or PHI. of its health plan participants. These obligations include privacy and security of the health information, no surprise there, as well as having a HIPAA business associate agreement in place with the insurance broker or the TPA or any other vendors of the employer or any other outside entities that have access to the protected health information. Now, the HIPAA obligations are different. They're the standards are the same, but the practical steps are different for different employers depending on what type of health plan you have. For example, whether fully insured and you're outsourcing a number of the HIPAA obligations to the health insurance carrier, for example, or whether you have a self-funded plan and maybe you, the employer, are handling a lot of the PHI internally. But in any case, this protected health information must be protected with privacy and security policies and adequate technological protection. And then also, in one of the common issues is that the employer has to do an analysis to make sure it identifies everyone that has access to the PHI, whether that's for the health plan or the dental plan or the vision plan, or whether it's for the health FSA or health reimbursement arrangement that an external entity like our firm may be helping with, and that the employer has these business associate agreements in place with all of those entities, whether that's the broker, whether that's the enrollment platform, whether that's the third-party administrator for FSA or HRA or COBRA or any other vendor with access to the PHI. HIPAA continues to escalate in terms of the enforcement by the federal government and the compliance risk for health plans, insurance carriers. The same obviously applies for medical practices. So this is something that we as employers want to be aware of. And so the best practice, I think, in 2017, not that all of us or all of you will have all the answers and you can figure them all out in 1 hour, but that you identify what the PHI is, who has access to it internally and externally, and then you go about taking steps to document what your HIPAA compliance is or needs to be so that that is in place. I think a reasonable goal would be by your next health insurance plan renewal or by the end of 2017. I think practically and reasonably that would be a good goal. So I won't say any more about HIPAA today. This will be the subject of some additional training later. And of course, those of you who are employers, talk to your plan advisor, or for those of you that have other compliance folks on your team, talk to them about what steps may be needed. Issue number 8, mistake number 8, leaves of absence. This is another hot button issue because these fact scenarios and these issues only seem to get more complex as we go. The common issue is this: employer does not have a formal leave of absence policy to address unpaid leaves of absence, including medical leaves or leaves of absence due to a disability of the employee or a health situation of a family member or the employee's leave for workers' comp. So the bottom line here is whether or not the employer is subject to FMLA, which usually applies to employers that had an average of 50 or more employees on an average workday in the prior calendar year, whether or not FMLA applies, the employer needs to have a formal leave of absence policy in place so that whether or not the employer knows about a leave before it happens and can communicate the terms of the leave to the employee, or more commonly, something happens with the employee or the employee's family member and the employee goes on leave and the employer is trying to address it in real time or retroactively, that the employer has a written leave that it can point to, a written leave policy that it can point to, number one, and that will control what happens during the leave with benefit plan elections, how, for example, if coverage is continued during the leave, how premiums are paid, or if premiums aren't paid, what happens to the coverage, whether it's continued or terminated, or whether the employee is given an option to make up premiums upon return from leave, and at what point coverage is no longer available to the individual. Now, in its simplest form, what FMLA is for employers subject to FMLA and employees who have an FMLA coverage right is that it is job-protected, coverage-protected leave for up to 12 weeks within a calendar year. And that's what FMLA provides. That's all FMLA provides. For leaves that are not subject to FMLA, either because the employer is not subject to FMLA as a small employer, or it's not a leave covered by FMLA, which relates to significant medical conditions of the employee or immediate family members. Well, if it's not an FMLA leave, then the employer is not legally required to follow the terms of FMLA, but it still needs to have documented what the terms of the leave will be, including whether coverage can be continued. If so, how will premiums be paid? If coverage is not continued, how coverage will be handled if and when the individual returns from work. So I could list 20 specific issues related to leave, but the common issue and mistake is that the employer doesn't even have a policy to control what happens in leave. Most all of us handle correctly paid leaves of absence. The employee goes on a paid leave of absence for a defined period of time. Pay continues, deductions continue, coverage continues, no problem there. Generally speaking, most all of the issues relate to unpaid leaves, and so we need to have a simple but effective and clear leave of absence policy to address those issues. And there are more issues to discuss. I'll save most of them for another day, with the exception of one, and this is issue number 9, mistake number 9. Whether or not the employer has a written leave of absence policy to cover unpaid FMLA or non-FMLA cases, that in any case the employer does not timely terminate coverage for an individual who goes on leave and then does not come back from leave within the FMLA or FMLA-like term of leave. FMLA, by the way, 12 weeks. Most short-term disability policies, which don't have to control the term of FMLA leave, but most of those are 13 weeks, including at least 1 week elimination period when the short-term disability first happens. Benefits start paying after 1 week, and then generally they pay for 12 or 13 weeks. So most employers draft a leave policy that's either 12 or 13 weeks. But in any event, the pitfall, the common problem is this. An individual goes on leave, maybe the employer, this is surprised by the leave, something medical happens, or it's workers' comp or disability. Then the individual's out for the 12 or 13 weeks, the 3 months, and then the individual does not immediately return to work after that. Well, the default scenario, and if most of you were, if you don't already know, if you were to look at your health insurance carrier booklet or contract, or the same would be true for other insurance, fully insured insurance policies, generally speaking, those policies only allow coverage for an inactive employee for up to 12 weeks, 13 weeks, or 3 months. Some are shorter, very few are longer, and I've seen up to 6 months. I've never seen longer than that, but most of them are 3 months or 13 weeks. Well, what that means is that if the inactive employee goes out, whether it's for FMLA or non-FMLA, whether it's for disability or workers' comp, if that individual does not return to work, well, his or her eligibility for benefits has terminated, and the employer can't leave them on the policy forever. So what the employer should do is know when the eligibility ends, let's call it 3 months, terminate the individual after 3 months from the coverage and offer them COBRA for the COBRA benefit, or portability or conversion if it's a non-COBRA benefit. But for example, health insurance, what we can't do as employers is just let the person stay on. Let's say they don't come back from leave for 6, 7, 8, 9 months, and we never terminate them, and then we finally decide they're not coming back, we terminate them. Well, we can't give them 18 months of COBRA on top of this long inactive leave, because the carrier is never going to let us leave them on the policy that long. So that could put us in jeopardy for potential claims down the road, because generally speaking, the maximum coverage period for an inactive or terminated employee would be the 3 months of inactivity plus 18 months of COBRA, the 21 total months. Some health insurance policies may have a longer inactive period, but most do not. And we as employers have to be aware of what our policy says. And so we want to know. And for example, for employers that supplement the carrier booklet with a RAP SPD, this is an issue that should be addressed in there. That if an individual goes on leave, or if an individual is inactive for any reason and they don't come back within, for example, 3 months, the coverage is terminated, COBRA will be offered. So this is a common issue, common mistake, and one that I think needs to be brought to the attention of all of us. A lot of employers have learned about this the hard way on the back end when it became a problem. It'd be better for us to know about it on the front end so that we can address it both in the SPD for the plan, in our leave of absence policy, which we want to be consistent with the SPD and FMLA if FMLA applies. So that's 9. And getting to 10, this is a less known mistake, but a common one, and another one that's the subject of some litigation around the country. I want to tip my cap to a broker partner and friend in Charlotte who first brought this to my attention a number of months ago when I was not aware that this was becoming a hot button issue, and I like this individual even though he's a Tar Heel. I don't hold that against him. Go Deeks. And the issue, the mistake is this, is the failure of an employer to provide notice of conversion or portability of coverage when the individual terminates employment or has a loss of coverage. Example, and this is most commonly seen with group term life insurance, and this is the specific topic and issue that's being litigated right now in various jurisdictions around the country, that an individual terminates employment or loses eligibility for the group term life plan, again, for example, because of inactive employment or termination for any other reason, that the group term life policy generally has a conversion provision that would allow the individual to convert or port the group term life insurance coverage by giving notice to the insurance company and converting that to an individual policy that they take with them beyond this employment. The mistake is that even though that's a provision of the group sponsored group term life insurance coverage, that the employer never gives formal notice of conversion or portability to the individual. And so the individual doesn't take the active step to convert it, and then they don't realize that that coverage expires. And then of course there may be death of the former employee, death of a spouse, death of a dependent. The group term life doesn't pay benefits because coverage has been terminated. The employee seeks advice and counsel, and then that plaintiff's attorney ends up pursuing a remedy against the plan for lack of notice of conversion or portability. So this is a complex issue that many employers have never thought about, but since we sponsor these group term life plans that have this option, then we need to make sure notice is given to them either by the insurance company on our behalf or by the employer. And the same would be true of a portability option of disability coverage or some other type of supplemental or worksite coverage that we, the employer, provide. But the key is providing notice. A secondary issue, which is not quite the problem of the group term life insurance, but there's a second issue. Most group term life insurance policies that employers purchase from a carrier and provide for employees includes, as you likely know, a waiver of premium rider or provision that if the individual becomes disabled, either on a short-term or long-term disability, that they can apply for waiver of paying the premium for the term of disability. This is something that employers who are plan sponsors should give the individuals notice of so that they have that option, whether or not they're still employed or whether or not they are terminated from employment, that they know that there's this waiver of premium option due to the disability. Again, sometimes the carriers will provide that notice on behalf of we employers, sometimes they will not. We just need to make sure that coverage is being provided. So that's the 10. Thanks for bearing with me during some of the long and some of the probably overly brief explanations. In terms of a summary, I hope that your response to the 10 common issues listed here is positive. I hope you feel like, wow, I heard some of these and there are not many surprises. I feel good about these. If you feel good about all 10, then you're ahead of the curve, and that's great. If you see 1 or 2 or 3 or 4 of these issues you need to address, you're not alone. I wouldn't place all 10 in the urgent category, but I would put them in the important category to address now or soon, hopefully within this calendar year, so that any potential issues or areas of improvement are identified and rectified. So I hope this has been helpful to you. I really like doing it in a practical, interactive setting with employers so I can hear what employers are doing and we can talk about best practices. I don't quite enjoy it as much when it's one-sided like this. I know Chris has been answering the written questions through the control panel. He and I are going to stay around for a few minutes and answer any other questions that either haven't been answered or that you submit now in the next few minutes. So if you have any questions, feel free to submit those now, and Chris or I will get back to you. Chris, any final thoughts?
I thought I would just jump in here while we're on and answer a couple of questions I think will be easier just by talking through it. Obviously, this has been a lengthy webinar, so if you need to go, that's fine. But if you want to stick around, again, I'll walk through a couple of them. The first was regarding the ERISA SPD, does the summary of benefits fulfill the SPD requirement? And the answer to that is no. Those are two separate requirements. The summary of benefits and coverage, SBC, is a ACA requirement that is separate from the ERISA summary plan description requirement. So those are two separate documents. An employer with a health plan needs to have both of those documents in order to be compliant with both of those requirements. We also had a question regarding a company that uses a third party to administer COBRA, and what requirements do the employer have to make sure all documentation is sent? Do we need to keep track that notices are being sent? I would say first that obviously the ultimate responsibility to send the documents lies with the plan, the employer. Now the employer contracts with the third-party administrator to send the documents, and so hopefully that contract protects the employer, but in addition, the employer should take some steps to ensure documentation is being sent. Practically, it probably doesn't make sense to confirm every single document is sent, especially if it's for a large employer. On the opposite side, it doesn't really make sense not to bury your head in the sand and not look at anything either. I think somewhere in between probably makes sense, whether quarterly you just want to do a quick review of documents that have been sent, if you can log into the TPA's portal, just to ensure generally that those notices are being sent. Jason, maybe we can go back to slide 9. We've had a couple of questions, and it looks perhaps you answered one of them in writing, but just generally, again, how that 3 months relates to different types of absences, long-term disability, short-term disability, or workers' compensation. And again, you can say more, but the 3 months or 13 weeks is generally a standard period, but you want to look at what the plan documents say, what your leave policy is to make that determination.
Yeah, Chris, good point. We're getting a lot of questions about the 3 months in various contexts. I'm going to just share my opinion for a moment. Chris, you can jump in with yours. My opinion is this. First of all, let's say that I've got a fully insured health plan, or if I've got a self-funded health plan that has a written SPD that maybe the health plan TPA provides, and certainly there's some requirements from the stop-loss carrier in the case of a self-funded plan as well. But first, I want to know how long are inactive employees eligible? Because, for example, if they're only eligible for 3 months, which is the standard, we need to make sure everybody either comes back to work within 3 months, they're still active, still eligible, or if they don't come back within 3 months, we terminate them, we offer them COBRA so that we don't violate the carrier provisions and we don't leave them on the coverage longer than they should. Where some of the confusion comes from is that employers, I think, understandably so, get nervous when the individual is away because they're on disability or workers' comp. As surprising as it may be, if an individual is on disability or workers' comp, that does not change the eligibility for the health plan. For example, if an individual is eligible for the health plan only if they're an active full-time employee that works more than 30 hours, and then the plan says that someone who goes inactive is only eligible for up to 3 months of inactivity, then it doesn't matter whether they're inactive because of workers' comp or disability or LFMLA or any other reason. That means from the time the individual goes inactive plus 3 months, if they don't come back within 3 months, they're terminated from the health plan. Now, they may not be terminated from employment, and they may still be receiving workers' comp benefits or disability benefits, but workers' compensation or disability does not directly change the eligibility requirements of the plan. And I think that's one of the dynamics that has led to the confusion and lack of understanding on this topic. But again, the key for employers is we have to terminate these people from the plan and offer them COBRA. Even, for example, some employer says, well, I want to keep continuing them past 3 months because they're on workers' comp. Well, employer, you can do that. Just do it via COBRA. You know, terminate them formally at the end of 3 months, give them notice that they're going on COBRA. The employer can even pay for the COBRA, all or part. That's fine. I mean, the employer can subsidize the COBRA and help that individual who's on workers' comp, but that doesn't change the fact that the way they're doing it is COBRA. Because again, what we don't want to do is just indefinitely cover someone as if they were active when they're not active, and then later down the road be fighting a claims battle with the carrier who learns that the person was inactive and says, you know, we're not covering this person for longer than active employment plus COBRA. You know, the dollars that could be involved in that battle could be huge. So we want to stay out of that altogether.
Thanks, Jason. We have a number of questions about, or requests to send information. If you will just email those requests to Christopher@ProBenefits.com, we can. I will go ahead and email that when I receive those requests. Maybe in the interest of time, Jason, we'll go ahead and wrap up there. There's a couple more written questions that I think we can answer in writing, and we'll respond to all if they apply. But again, thank you to everyone for joining us. And again, no webinar in July, and we'll be back in August.
Yeah, thanks everyone for your time. Thank you, Chris, for your great job on the webinar so far this year. Those of you that have submitted a written question, you're welcome to hang around for a few minutes. Chris and I'll stay on for 5 or 10 more minutes to answer the questions already submitted and any more submitted. If you need to go, that's fine. You're welcome to email your question, as Chris said. Again, thanks for your time today. Best wishes for a great summer, and we'll talk to you soon.